My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to help you make some money. My job is not just to entertain, but to educate and teach you, so call me at 1-800-743-CNBC or tweet me at Jim Cramer. I think something's changing in this market. Look, we should have gone down Friday huge after that gigantic Thursday rally. We should have gone down and stayed down this morning because of the FTX scandal. Something that definitely would have crushed a less vibrant market. And we should have been slammed all day when Chris Waller, an important Federal Reserve Board governor, said this weekend there's a ways to go before the rate hikes end. Instead, we get hit in the morning, and then next thing you know, Lael Brainerd, the Fed's vice chair, used the word soon in relation to a slowdown in rate hikes, which is exactly what the bulls want to hear. And then we had a nice bounce until we did indeed roll over. At the end of the day, ultimately Dow sinking 211 points, S&P losing 0.89%, NASDAQ falling 1.12%. But the fact is, this market put on quite a show for most of the day before some late-hour selling. You want to know why this market has become so resilient lately? I think it's because of thinking like we got from Vice Chair Brainerd. If the Fed's not going to tighten aggressively from here, still tighten definitely, but not aggressively, the bears won't have enough fuel to keep mauling the averages. Now, you might think this is happening too painlessly, but that's actually not true. It's where the pain is highly concentrated. We're seeing layoffs and closings left and right. Think crypto or lunatic techno apparel ideas or fattened up enterprise software firms that have done so well for so long they've never needed to bother with efficiency. We're starting to see some layoffs at Amazon. I think there are many more to come there. Larger ones at Meta Platforms. And I bet there'll be more coming from big tech. Does Alphabet really need all these people, including the ones they just added? Does Microsoft? I don't think so. They've just made so much money for so long at these companies. Maybe they just don't know how to fire. Now, if we look at anything tech, fintech, real estate tech, enterprise software tech, or anything that needs advertising tech to make the quarter, we know exactly who is feeling the pain.
The house of pain.
It's just less visible to those who don't work in tech. And it's not just that they're firing people. So many of these tech companies offer their employees tons of what's known as stock-based compensation. Yeah, a big part of their income is from stocks. But now that their stocks have collapsed, a lot of that compensation is going up in smoke. Still more has to be perhaps paid out in cash. The purchasing power of these people is being destroyed, and the companies aren't doing as well once we see what's really happening. Once you pull back stock-based compensation, you'll see they're not doing that well. The pay's also in the companies we've never heard of. The startups that were supposed to come public and didn't. The ones David Solomon, CEO of Goldman Sachs, talked about last week. He explained that there's a queue to come public, but to me, that's a queue to nowhere. There's no appetite for IPOs here, and it won't come back until the market's more secure. And forget about SPACs, please. The craziest thing, though, is what people are buying. Later tonight, we'll talk about what I call the if recession, as in if there's a recession, here are the stocks to buy, not sell, even as they're exactly the names you're supposed to sell in a normal slowdown. You think the bears will be betting against the nation's best steelmaker, Nucor, which roared higher today, not lower. The usual suspects, the cyclical stocks, you usually line up against the wall and just annihilate. They spent the last few weeks rallying like crazy. They're not immune, but they seem immune to a slowdown. These industrials finished the day up nicely, even when the whole market pulled back into the close, because the market is led, of course, by tech, which is the biggest sector. But companies that let you buy now and pay later or help businesses figure out who's creditworthy or the ones that make point-of-sale systems, these are a dime a dozen. And you know what? Frankly, most of them they're just prosaic nothings. I mean, who can even keep them straight? I have to look them up every single time, and I know a lot of companies. Same goes for the companies that help manage, massage, explain, or protect your data. I wonder if you couldn't just have all that done by two companies, Palo Alto and Salesforce.com. All right, throwing some service down, maybe some Workday. By the way, Salesforce has gotten religion on controlling costs. They're slimming down the business while buying back $10 billion worth of stock. In the old days, you'd expect them to be issuing $10 billion worth of stock instead of buying it back for the shareholders. Here's the question, though. Are the losses in tech and crypto big enough to make a difference to the Fed's thinking? I look at it like this. The Fed doesn't want excess, and Silicon Valley is the poster child for excess. Do you think there's excess at Norfolk Southern? You think Deere has too many employees? Union Pacific? That's nuts. A railroad like Union Pacific let so many people go during the pandemic that they're actually struggling to find people to work. That is not a sign of excess. Now, let me make it clear what I am not saying. I don't think the crypto collapse by itself will cause the Fed to relent. However, I bet they're very happy to see the speculative bubble popping. There were just too many crypto Powerball winners, and that's ending. There are so many different kinds of coins that they're just ridiculous. Stable coins, joke coins, alleged coins, new minute coins, all backed up by the full faith and credit of really angry people on the internet who have a million reasons why they're right and you're wrong. And they don't believe for a moment that they possibly could be making big mistakes here. They talk about decentralized finance when you bring up what a bunch of joke things are. And somehow, as DeFi, Bob, makes it so that you can have Shiba Inu or Polkadot or Chainlink or Dogecoin, as if you take any of those coins if you ran any kind of business, even a lemonade stand. The cryptids were able to keep this game going for ages because they're so loud and combative and angry. But as the industry implodes and we find out about scam after scam, no amount of tweets or Reddit posts is going to turn things around. It's been crypto mob rule for too long, and the mob is starting to weaken. As for tech, when I look at how many of these companies that were created just, say, to generate sales leads, I mean, I got to laugh. I taught sales at Goldman. I mean, enough already. If there are so few businesses being started, and there are, and you've already sold them your software scheme, or at least given them the free version, then forget about it. I cannot believe how many cloud software companies exist to get things cheaper or help their clients win customers for less money. You could roll them all up into one firm and nobody would know the darn difference. Now, we're all used to the old line industrials taking on the chin when the Fed engineers a recession. But let me ask you, if you're a software engineer for Alphabet or a programmer for Meta platforms, do you feel like buying a new beach house? Or are you sweating out whether to buy a Whirlpool washing machine at Lowe's? I think it's the latter. Tech work suddenly got very, very precarious. Of course, tomorrow we're going to start hearing from another group of precarious stocks, the retailers. And that means we'll be hearing about tales of macroeconomic environmental woes. That's right. The macro environment's tough. Remember, they always blame the environment. It's never like they got the wrong merchandise. They just want to blame the headwinds from inflation and the Federal Reserve for their problems. That's okay. Doesn't matter. It's time honored. What does matter, though, what you need to know is that other than travel, people aren't really doing much. They're hunkered down now, trying to figure out if they should go back to work while going to their 10th wedding since we came out of the pandemic mode. They're trying to figure out how much longer they can take spending so much on renovations. And what's with the fancy clothes? They don't know what to do. Yeah, we'll get an earful from the retailers, and I think most of it will not be pleasant. But the conclusion is simple. There's enough turmoil that the Fed needs to slow down its rate hikes, if only to prevent the headwinds from turning into some sort of weird Cat 5 hurricane. Here's the bottom line. Even though it can be hard to notice, the Fed's already done a great deal of damage to the economy. It's just that it's all packed into the most bloated sectors, and that no longer includes, say, housing, the typical brunt bearer. And maybe, just maybe, we can cool down inflation by burying tech and crypto without crushing the rest of the economy. Let's go to Seth in Texas. Seth.
Hey, Jim. It's good to talk with you. I'm a member of the Investing Club, so I know you're big into Wells Fargo. I really like this new CEO, Jane, at Citi, and I really like the tangible book value. But why? I guess, what do you think about? Like, what's your thoughts on Citi as a whole?
Okay, I think she's doing a great job, but I need to know how that tangible book value could be so far above the where the common stock is. I have to tell you that something is wrong there, and I don't know what it is. But you should not have that variation between tangible book and where the stock is, and I find it quite disconcerting. Bob in Ohio. Bob.
Hello, Jim Cramer.
Yes, you got me, Bob. What's up?
Hey, great to talk to you. Thanks for taking my call. First time, long time.
Thank you. Oh, hey, excellent.
My question today is about Dominion Energy. I've been accumulating shares for about 10 years. So needless to say, it's been somewhat of a disappointment. Now we've got management talking about a review of the businesses and potential sale of more assets, most notably the Cove Point plant.
Right.
Do you see something good here for the long-term investor, or is this just going to be a house of pain?
You know, I have been very, very confused. CFO leaves, top to bottom. There's something wrong at Dominion. And I'm not sure until we get the full airing what the heck it is. Right now, you have 4.6% yield. How about we wait till 5%? I think the dividend is safe. Look, I'm going to be very candid here on this one. Bob, I have not a single idea what's really going on at Dominion. They should come on air and explain it to us, because we've been really good supporters of Dominion, but not this Dominion. Let's go to Charles in Maryland, please. Charles.
Yes, good afternoon. How are you today?
I am good. How are you?
Good, good. Quick question. I know MSFT Microsoft is one of the companies you like in terms of having bottom-line profits and good fundamentals. The question I have for you, though, is at this price or where it is now, do you think it's a good time to buy, or should we wait until it drops a bit lower?
I want you to wait. We sold some for the Charitable Trust today. I never thought I'd sell any Microsoft. But I think these tech stocks are many of them are just overinflated, and they're going to get hammered. And we warned people last week with the Charitable Trust who belong to the investing club that we would let some Microsoft go, and we did so just like that today. Right? The Fed's already done a great deal of damage to the economy. They said it's all packed into the most bloated sectors like tech. Maybe, just maybe, we can cool down inflation by burying tech and crypto without crushing the rest of the economy. On Mad Money tonight, for a while it felt tough to find some solid winners in this tape, but after a nice recent run of the cyclicals, now what do you do with the sector? I'll give you my take, and it should be pretty surprising. Retail earnings, they are on deck this week. Could this be a turnaround quarter for a host of big names, or do we have to wait? I'm sharing what you need to know. And Logitech's been on a roller coaster for stock, so what should you do with the hardware company at these levels? I'm talking to the CEO, so stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.